This program is titled Anatomy of an Insolvency, and it features Kelvin Schill, Senior Vice President of Financial Services at Country Financial, and Janice Potter, Executive Director of Illinois Life and Health Guarantee Association. Originally delivered to a live audience of both on-site and webinar participants, the session originated from the campus of Illinois State University. It's a collaborative effort of the Institute's Griffith Foundation, IRF, and the Cady School of Insurance at Illinois State. In keeping with the respective missions of these organizations, this session is purely instructional in nature and does not support a position on any issues.
It's my pleasure to be here. Kelvin and I have been part of this program probably for the last 6 or 7 years, and it's always our pleasure and privilege to be here, and especially here today, June 21st, 2022, the longest day of the year, right? But yet all of us are back together, which is just wonderful. If you've read Kelvin's bio, you'll see that he's an avid runner. To me, that means he runs marathons. I am a very poor runner, but I'm saying that to say this, that we will try to run through this program just as quickly as we can on this longest day of the year to get you back out into this really great weather. As Frank mentioned, we're going to do an anatomy of an insolvency. And we'll kind of walk you through what gets us to an insolvency and also use 2 real-life case studies. One will be Penn Treaty, which will focus on the long-term care block, and the other one will be Lincoln Memorial, which is the life insurance pre-need policies. Kind of sensational, and I think that you'll find it very interesting. Let's see, as we move on, and I need to stop and pause and thank Jim Jones as well. Through his efforts and his team, this is all possible. Jim joined our board about 2 years ago, and in Illinois, we are somewhat unique in that we have 2 public representatives that are appointed by the Director of Insurance. So with Jim coming on board, if you will, he's really given us a different view, different perspective. Kelvin has been on the board for several years. He chaired our board for 5 or 6 years, and I am better for him because of that. And Country Life, the company that he represents, has been on the board for quite some time. So we are made up of 1,100, we represent 1,100 member insurers in Illinois that are licensed, and then our board is 11 individuals strong. The kind of information sheet that you have in front of you, Mike, you have it right there kind of under your elbow. That's the Illinois Guarantee Association. That's an education piece that I put together recently to help, let me put it this way, to help my mother understand what I do, how I do it, why I do it. And I think that trying to explain it to her was a little bit complicated. So I hope that you will find that to kind of a one-sided piece of paper, two-sided, on 2 sides that will help you and me and others understand. So as we go through, we are going to have our very first polling question. And for those of you that are remote, I think that everything is set up to answer kind of accordingly. And I think that I can just start here. All right, to kind of get to know each other, if you could maybe here in the group, just kind of raise your hands, what area of expertise do you have and how long you have been with the department. I thought it was interesting. I got here about 8 o'clock and I was accompanying him with a gentleman, Eduardo, that I got to know from California. So he's on, I don't know, 6 o'clock time, right? So he was the first one in here and we got to know each other, and he's been with the department for 2 years. So again, just to kind of get to know each other. So with that, if we could launch the poll, or is the poll already launched, Debbie? All right, good. All right, so as we're going through here, how many are kind of have the financial background? Wow, very good. An actuary? Don't want, there's Ellie is the actuary, and you really have the pleasure of knowing her. I didn't see Kelvin raise his hand though, so, and then compliance general counsel. So it looks like most of you are from the financial aspect, which is dear to my heart because I'm a CPA, so I get you, put it that way. Oh, there we go. There's kind of the polling questions that prove that out. And then the experience. Looks like most of us are 5 years or so. Very good. So that's really good to know. Welcome. I hope that you take this back to your departments and really share the value of this program. I think we're stronger because of you. Okay, now, it's always a good place to start at the beginning, and how and why and the steps that go into an insolvency. And I think the next couple of minutes, you'll hear more about someone who is very seasoned in this, kind of talking about the capital standards, the markets, and where we are all going from here. So with that, I'll turn it over to Calvin.
All right, thanks, Janice. Really appreciate it, and glad to join you all this morning, and those online as well. So essentially, when we talk about insurance is essentially a promise that's being made, right? So consumers are paying an amount up front, they're paying a premium in order to transfer a risk to an insurer. And when a covered event happens or a claim at some later point in time, the expectation is that the insurer is going to do their part, as you know, under the contract there. And so insurance is essentially a promise. And so what's needed to have insurance work is a trust in the industry. And so trust is essential. And think about it, if just one time that trust is betrayed, what a catastrophic result that would have on the industry as a whole. And so as a result, regulators play a very, very important part in terms of ensuring that the companies in their marketplace really are delivering on those promises that are being made day in and day out. So because trust is such a vital part of what insurance is all about, there definitely is a need that if things get bad, if things get really, really bad, that insurance companies can still deliver on the promises that they've made. And that's essentially what we mean by capital standards for insurers. Insurers hold a certain amount of capital and surplus in order to ensure that if things get really, really bad, that they're not going to go under, but can still deliver on the promises that they've made. Both Janice and I work on the life insurance side of the house, and on the life side, you're typically taking in more premiums than you're paying out in claims early on in the life of the contract. And so insurance companies will set up reserves as almost kind of prepaid claims there. And those reserves are essentially going to cover about 2/3 of the bad situations that can happen. But again, we don't want a company to be just okay 2/3 of the time. We want it to be okay essentially all of the time. And that's why there's capital and surplus that's essentially going to handle about 99.5% of the scenarios out there. Think of it like a 1 in 200 year scenario there. And even coming through the pandemic most recently, that was inflated claims for a lot of life insurance companies. And yet I don't believe that there's any life insurance companies, at least, that have gone insolvent strictly because of claims there. So that's really the reason for capital standards, because insurance is really based on a promise, and trust is essential in order for the insurance marketplace to work. So we can ask ourselves, how much capital and surplus do companies need in order to stay solvent? When things get really, really bad, how much do they need? A couple $1 million, a couple $1 billion? Well, back in the day, we're talking decades ago, the standard was you had a fixed dollar amount that you had to hold in order for your capital requirements. And so as an example, if you're a medium-sized insurer, you needed to hold $6 million in your capital. But is $6 million enough? Well, in the 1980s and 1990s, we saw that no, $6 million was not enough, and we needed more sophisticated standards in order to ensure that each company was holding the appropriate amount of capital. And so regulators, along with the industry, developed what's called risk-based capital standards in order to really provide a common measuring stick and to account for the different risks that are associated with different lines of business. And so risk-based capital essentially has 4 main components. There are assets, risk related to assets, risk related to underwriting, risks related to interest rate fluctuations, and then business risk as well. And so what regulators and really what the public at large can do is really compare what does that risk-based capital look like relative to the actual capital that a company is holding. And so just as a quick example, Janice mentioned I work for Country Financial. Country Life Insurance Company is our main life insurance legal entity. We're multi-line. We do both P&C and life. But in our life insurance company, our authorized control level of risk-based capital is about $146 million. Our total adjusted capital is about $1.7 billion. And so you take the total adjusted capital divided by the risk-based capital, that gets you a percentage of about 1,200%. Now, a lot of companies don't like to compare to the authorized control level. That's when you all regulators can essentially come in and take over the company. So we compare, most companies compare to what's called our company action level, which is double the authorized control level. And so the comparison is essentially that $1.7 billion of total adjusted capital to about $300 million of company action level RBC. So that gives us a risk-based capital percentage of about 600% there. So RBC is certainly an important tool for regulators to really focus their resources on companies that have the highest risk of insolvency. It's an objective measure of solvency. It's a good tool for companies to understand their own risk and really be able to identify where some of their weaknesses are, and also heightens the success on delivering on the promises. So quick polling question here. Why are capital standards important to measure the solvency of an insurance company? And you see the options there: to determine the success of the company, predict profitability of the company, point out possible weaknesses, or it has no bearing. So what do you guys think? There are multiple choices here, but just maybe call out a few answers here. What do you think might be the best answer in terms of capital standards, and why are they important? Anyone like to give us a shot here in the room, and then we'll go to the answers online. What was that again? Yeah, it's an objective way. Certainly you can look at an RBC percentage, and as that gets closer and closer to 100% or below 100%, and some of the examples we'll look at, that certainly is one. Any other correct answers there that you see, or good answers?
Point out weaknesses.
Yeah, point out weaknesses, exactly. I mean, one thing for our company is with interest rates being at historic lows, at least till the last couple of months here, we had a lot of interest rate sensitive business, and so we wanted to do some things to shore up there. Very good. All right, well, let's see what everyone did. Point out possible weaknesses, objective way to determine solvency. I think those are the two, I would say, best answers that are there. So capital solvency, again, a very, very important part of at least the beginning of an insolvency, and hopefully having enough capital to avoid a solvency altogether.
All right, as I mentioned, I am from this great state of Illinois, and we are very fortunate to have a very strong Department of Insurance and a very strong leader at the department. Tomorrow you will hear from our director, and I really hope that you set aside time to hear from her. She's a very knowledgeable individual, great leader for our state. I know here, I'm going to scan Brian. You're from Illinois. Perfect. I think there was another person from Illinois too as well. And the gentleman in the back, I know that he's from Illinois too. The face looks very familiar. So again, and from Indiana. So I think that the department is just so vital to what we do. And you're probably asking, okay, so how does the Guarantee Association fit in? In almost all states, we are created by statute, but we're not a state entity. And so we really work very closely and collaboratively with the department. So the mission of, I think, any department is to protect consumers, protect residents, and the solvency of insurance companies certainly fall under that. But what happens when that goes the other way and a company becomes insolvent? That's where we too provide that protection, if you will, the safety net, if you will, for Illinois residents, for consumers. So again, you can see there what our mission is, and we really take that to heart. I am fortunate to be surrounded by a team of 8 strong individuals, and they are here to serve Illinois. And again, it's a privilege to have them by my side day in and day out, especially over the past couple of years. So here we go, another polling question. Do you know anything? Did you know anything about the Guarantee Association walking in here? So let's kind of start. I knew nothing about you. Show of hands. Oh, okay. I knew a little bit. Very good. How little did you know about us? And I knew everything about the Guarantee Association. That's really, I think, very helpful. And again, I go back to my mom. What do you do exactly? And we're not the FDIC, which a lot of people, oh, okay, I know about the bank. But the insurance company aspect of it and how we are such a vital, we don't sell insurance, but we play a vital role in the insurance space, I think is just so important. So that's why this was developed to kind of very, very high level. There's pictures on it. So again, to me, I'm very color focused, that I hope that you'll take this away and just kind of get a really good glimpse of what we do, why we do it, how we do it, who we serve, why we serve. And really the numbers are quite staggering. The Illinois Guarantee Association was created back in 1980 by state statute. And since that time, we have serviced over 80 different insolvencies. That adds up to over $80 million. So it's quite significant. So you might be asking yourself, okay, we are nonprofit, yes, but I don't go out and fundraise. Who really is the backer, if you will, when the insurance company goes insolvent, are our member insurers, are companies like Calvin's, the State Farms, the Northwestern Mutual, Principal, Prudential. I've named all of those because those are on the Illinois boards. We have really strong leadership there to healthcare services as well. So let's go ahead and see what the polling. Good, some understanding, and thank you, because I think that you are the eyes and ears as to what you see when you go through an exam or an analysis. So again, I appreciate everything that you certainly do. I encourage you to continue on with the journey. And wow, 14% are very knowledgeable. So thank you too. Okay, so how does the Guarantee Association provide this protection? We call ourselves kind of a safety net, that when a company goes insolvent, we're there to kind of provide that resident consumer protection up to a certain limit. So you'll see in a couple of slides, and also on the back here, that we have statutory limits. For example, if my mom, and she's not, was in a long-term care facility, and she is submitting claims, that we would pay up to the statutory limit of $300,000. So again, that's something that is there to kind of keep in mind, that we do have a cap that we need to really make sure that we don't exceed. And again, I mentioned that we're created by state law, and generally we are triggered, if you will, when there is an order of liquidation. And that's when we start kind of paying claims, really figuring out what to do now, because we are stepping into the shoes. How an insolvency work, we can spend all day on just one of these buckets, but an order of rehabilitation is entered, and then we begin to pay benefits. And again, going back to that, $800 million is what we have paid. We need the solvent member insurers, and we make assessments. That's what we call, when an insurance company goes insolvent, we assess our member insurers to make up whatever that liability difference is. So again, a general receivership timeline is that a troubled company is identified, and then they can be in administrative oversight, or they can go into rehabilitation. Kelvin is going to talk about a company that is right now, as we speak, in rehab. And all this information is certainly public information that Kelvin will talk about. There is a national organization that all life and health guarantee associations are part of, called NOGA, the National Organization of Life and Health Guarantee Associations. So when there is a multi-state insolvency, now NOGA coordinates that through a task force. And that really benefits everyone, the entire system, because we share in cost. We share in the cost of actuarial services, of financial services, of legal services, to get through some very complicated insolvencies. And then at the time of the liquidation, there's a couple of different options that we have. We can go through an assumption agreement. We can begin to pay claims. We can see whatever assets are there because the Guarantee Association becomes the major creditor. And so we really pay close attention to what assets are still available. And then we kind of get to the end. I started out at the beginning. The end can be decades on an insolvency. And so when that happens, there could be estate assets that are still there that are then distributed back to the Guarantee Association, and that in some instances are distributed back to the member insurers that paid in to close that gap in terms of the outstanding liability. Okay, the statutory limits, I talked about this. I gave an example of long-term care. A couple of years ago, Illinois was one of 24 states that had a co-op. And when that co-op was insolvent, we had the health line that's impacted the health line that had a $500,000 statutory limit. We'll go through an example of Lincoln Memorial, which was the lifeline that has a $300,000 statutory limit. So again, these are statutory caps that we need to really pay very close attention to when we are paying and funding claims. Okay. Every troubled company goes insolvent. Yes or no? How about the yeses? How about no's? Oh, unanimous. That was kind of I think it was too simple, but I had to put something in there, right, to kind of break up the monotony. I kind of triggered it too quick, but I'll give it a few seconds. But I think that the audience outside of the screen will probably agree that no. Just because you're in financial trouble does not mean that you're immediately going to go insolvent. Okay, so here we are. The tale of two cities that I've switched up to the tale of two insolvencies. And I think what you'll see as Calvin starts is that no two insolvencies are alike. They can be for many different reasons. And I think by the time we get to an hour from now, you'll see that, yeah, it could be from many different reasons. So I'll turn that over to Calvin to kind of set the stage, if you will.
All right, a lot of great information, and probably the best way to understand the Guarantee Association is really to walk through a couple of examples, and that's why we have some case studies that we're going to do. But before we get into that, while no two insolvencies are the same, there are a lot of common factors that basically result in an insolvency. AM Best, who's an organization that does ratings for the insurance industry, did a study a couple years back to really identify what are the main factors that result in a company going insolvent. And it's usually a combination of these factors that eventually results in insolvency. And so as we go through these particular case studies, I think this is one thing that you'll want to be paying close attention to is what are some of those factors that ultimately resulted in Penn Treaty as well as Lincoln Memorial going through insolvency. And so the other thing is Janice and I will give an introduction I'll do Penn Treaty and Janice will do Lincoln Memorial. But these are really the 6 questions that we're going to break out and then discuss further in terms of what were maybe some of the early warnings that gave indication that not all was well at these companies, what specifically went wrong, and we can look at the list on the AM Best study to identify that. How long before the insolvency? That certainly plays a factor in terms of how whole the clients ultimately can be. What regulator action was taken, what Guarantee Association coverage was available, and then finally some lessons learned. And so again, we'll give an introduction to the case studies. We'll break out for those that are here in person and really focus in on these 6 items. So let's jump into the Penn Treaty case study. Penn Treaty is located in the great state of Pennsylvania. Where are my Pennsylvania folks? They're in Pennsylvania, Steve. Steve said he had nothing to do with this, so there's no implication there. And really, Penn Treaty was a one-trick pony. They sold long-term care exclusively, and they sold quite a bit of long-term care. And just a little bit of introduction on this product in case you're not familiar with it. One of the most significant risks in going into retirement is really the risk of health expenses that you're not able to pay, and those health expenses can come from a long-term care event. Just to give you a sense, if you went to the most expensive college or university in the United States of America, it would cost you about 75 grand per year. That's like the top elite one. Well, here in Illinois, the average cost of skilled nursing is about $82,000 per year. And so you think about it, that's a major expense that most Americans aren't really equipped to handle, and it's not covered by and large by Medicare. And so this is a big risk to people having a successful retirement. And so in the 1980s, this became kind of a focus. Actuaries who are successful in the life insurance space said, hey, we can do something about this. And similar to saving for college, where you save a little bit over time, then you have enough to help offset those expenses. Let's create an insurance product where we pool the risks of long-term care. We save a little bit for a longer period of time, and then as those claims come out, then we'll be able to pay those. And so we've got a short video here that goes through some of the risks of long-term care and some of what did not go right.
Well, the problems with the long care industry are not new. The industry has changed dramatically over the years, so GE isn't the only company with exposure to that sector. We're joined tonight by Doug Bonaparte, president of the wealth management firm Bonafide Wealth. Doug, welcome. Nice to have you here.
Good to see you.
You know, the cross currents in healthcare have really been working against this industry, correct? Healthcare costs going up, people living longer?
Yeah, those are the two biggest headwinds.
So if you are an investor looking to perhaps see whether or not you have exposure in your portfolio to a company that has a large or sizable long-term care insurance, what companies would you look at?
Sure. So the biggest one that comes to mind is Genworth Financial. They're probably one of the largest producers of long-term care insurance. John Hancock has left the business since, and you also have Mass Mutual as a company who is a big producer of these types of policies as well.
Would you stay away from them as an investor in general?
I can't give a specific recommendation as to whether or not you should buy or sell these companies, but I can tell you that if your concern is exposure to rising healthcare costs as well as aging population in the context of long-term care policy and risk exposure that they have, then you should probably tread lightly with regards to that exposure.
And what about liability for some of these companies?
Sure. So what you see happening today is the companies that have this type of risk out there have been attempting to increase their premiums over the last several years to basically meet up with the miscalculation of the costs associated with the rising cost of healthcare as well as aging demographics. So for policyholders, this has proven to be a costly proposition, as they have seen their premiums increase dramatically, in some cases north of 75 to 100%.
Doug, thank you so much.
You're
Doug
very
Bonaparte with Bonafide Wealth.
All right, so you certainly see some of the risks that are associated with writing this line of business. And if you have a company like Penn Treaty that only wrote this kind of business, you can see some of the perils that can be there. You know, really there's five main assumptions that actuaries had to estimate in order to come up with appropriate premiums for this particular product. And in the video clip, they certainly mentioned one of them, where people are living longer within on a long-term care benefit. And so the severity of the claim is one of those. The frequency of actually going on claim is another one of those. The mortality rate of essentially when someone's going to pass away, either before they go on claim or while they're on claim. You know, essentially the lapse rate, how many people voluntarily give up their contract, and then the interest rates is another key component to that. You think about those are the five key items that actuaries had to get right. They got 0 of them right, and so that was an issue. And what makes it even worse is that not only did they get it wrong, there's such a long period between the time at which you price the product and the time where you really start seeing claims and how are we doing with respect to experience. You know, when you see the claims and you see things are going off the rails, it was too late to really have early corrective action where you could do slight adjustments to get back on track. And so that's why you heard on the video clip, long-term care carriers really coming up with massive, 50, 75, 100% rate increases in order to try to get the product back on track there. So a couple other features that are important to understand with long-term care, and features that Penn Treaty certainly had, which were common within the industry. Inflation riders, where the benefit that's being paid out increases by sometimes 5% per year. Sometimes that's a simple, sometimes that's compound. And so you can see where the benefits, compounding interest, really ramp up quickly and becomes a rich benefit there. Another feature was lifetime benefits, where most long-term care stays are about 2 to 3 years. But if you have a situation where someone has dementia or Alzheimer's or another long-standing debilitating factor, those can last years and years and years as well. And if you have lifetime benefits, you can easily pay over millions of dollars for a single claim there. And also limited pay policies. It was common early on, in particular, to offer this particular product where an individual maybe just paid 10 years of premium, where essentially if they're through that premium paying period, then there is no rate increase mechanism to self-correct if the company finds that their experience is coming out differently than how they price the product. So these were certainly some of the issues at Penn Treaty. And some of this was really exacerbated by the fact that when things started to go wrong at Penn Treaty, there were a lot of parties involved that had a lot of different viewpoints in terms of what should happen. You had the owner of the company essentially saying, I don't think there's a problem here. I think that our experience is right. And unfortunately, you can find an actuary almost anywhere that will kind of back that up. And you also had agents who said, hey, we think that whatever corrective answer is, we should continue to receive our commissions because that's our livelihood, is to continue to receive things there. And then you had the regulator who had a certain view, and then you had other insurance companies that also had a different view. And so as a result of years and years of bickering, it was 2001, so a little over 20 years ago, that things first started to go bad at Penn Treaty. And so 2001 is when things started. They were initially moved into rehabilitation, came with an acceptable plan of rehabilitation, came out of rehabilitation, only to go back into rehabilitation in 2009. And then it really took a while to work its way through the courts. The plan of liquidation was eventually denied in 2012, so we're talking about a 3-year period there. And then there was more and more legal wrangling until the company was finally liquidated and went into insolvency in 2017. But there's a real cost of delay. One of the things that you'll see here are just the stats for Penn Treaty at the time of the insolvency, just for the state of Illinois, which the Illinois Guarantee Association was responsible for. If you look at the blue box in the lower left, there were $92 million of anticipated liabilities. And so that would essentially be, what are all the future claims that we expect to pay out there? And then there are estate assets that are transferred to the Guarantee Association at the time of insolvency, just $7 million. And so had that been several years before, those estate assets would have been likely higher, but that gap essentially became the responsibility of the members of the Guarantee Association. So one of the things that we will look at in our case study are these 6 questions. Once again, so I'm not going to go through those now, but you think with an event like Penn Treaty that was very, very difficult, have we learned our lesson yet? Well, not yet, because there's at least one other large company. SHIP is its current name, Senior Health Insurance Company of Pennsylvania. Again, great state of Pennsylvania. Handling up. Yeah, we're not picking on you, Steve, here, but SHIP is another entity that is under challenge as well. And again, this was a special purpose entity that was created by Conseco with all of their long-term care liability. So again, a company that solely has long-term care risks, and essentially, you'll see the first bullet tells it all there, almost $1 billion deficit. So you look at all the future claims versus all the future premiums and assets that are there to cover that. You have almost $1 billion deficit at this point, and 90% of the policyholders are over 80 years old. So it's not quite as large, at least from an Illinois standpoint or nationwide standpoint, as Penn Treaty, but again, a very, very costly issue. And again, because of some of the delay and some of the legal wrangling and such, the problem only gets worse as opposed to getting better there. All right, so with that, I'll hand it back to Janice. That's an introduction to Penn Treaty. Lincoln Memorial has a few different aspects that were included with that.
Just a few notes about Penn Treaty. As Kelvin highlighted, that the Illinois liability was $92 million. For nationwide, it was $3 billion. So that was pretty significant. And we are in year 4 now of paying the claims. Illinois has sophisticated staff in order to handle the claims process. So we adjudicate the Penn Treaty block, we call it. And the little blue, they look like little flowers that are in front of you. Linda, do you have that under your quarantine thing? It's kind of a jar opener. I know my mom used to use it. My grandma used to use it, right? And as Kelvin mentioned, our demographics are elderly people. So in order to kind of let them know that Illinois Guarantee Association is here, we mail them out to all 3,300 policyholders. So that, because you know what, I think it resonated with them. To kind of, communication is so key, that we are dealing not only with the elderly, but we're dealing with their children too as well. And very, sometimes very stressful times. So I just want to emphasize that Illinois Guarantee Association especially cares about, you know, long-term care insolvencies. Other states are right there with me as well. So I just wanted to kind of highlight that. So moving on, as Kelvin mentioned, that no two insolvencies are alike. Penn Treaty was this one-trick pony. Lincoln Memorial was quite unique. I started at the Guarantee Association back in 2012. And so Lincoln Memorial was already cooking. And it impacted 35 states, of which Illinois was one of the biggest ones. And, you know, I was getting myself grounded, getting myself landed in, you know, my new role. And, you know, it was all about Lincoln Memorial. And I had no idea, you know, kind of the depth and breadth and kind of sensationalism of this case. So kind of in a nutshell, that, and this is, it can't be in a nutshell, so, you know, please forgive me for that term, that it was a Texas domiciled insurance company that wrote pre-need insurance. So, you know, if I want to make sure that I don't burden my family upon my demise, I go out and I purchase this pre-need policy. And then there was kind of like an operations arm, National Prearranged Services, NPS, that was in Missouri. So you can see why there's such a, well, why is Illinois and Texas? That's why. They really, Missouri took a beating, Illinois took a beating because we are very close in proximity. Both companies were owned by a family, the Cassidy family. And I think those that might be joining us remotely, they might be starting to Google Doug Cassidy, 6 Feet Under, Forever Cemetery. Again, these were all very, very foreign concepts to me back in 2012. And the insolvency happened that they obviously collected a premium, but then they took that premium, put it in the bank, and then they raided their bank for their own personal gain. That they went out, bought a yacht, $20,000 for a one-night stay in Shanghai. Again, they were just really, it was just astonishing what they did. And again, when they went under, that the Guarantee Association was, they got this, they got the liability. And again, this was all for financial gain. This was all for fraud. F-R-A-U-D, right? Who's a Wordle? I'm kind of gotten into Wordle here, and that is my word of the day, fraud. It won't win. But again, that is something that was the reason for this insolvency. So we'll kind of go through very short video clips to
well, Doug Cassidy,
a background from the FBI.
Throughout this whole investigation, his claim was that, the $400 to $600 million that was missing didn't go to him. That they earned a salary, but this was not a crime. Through the course of the investigation, we found that, in fact, cash was being mailed to him by one of the office managers at NPS on a regular basis. Approximately $1,600 in cash we put in a FedEx envelope and overnight it to Doug whenever he wanted it. He would email or contact the office and ask for the money. And the money would, if he was on Nantucket, there's a FedEx, $1,600. If he's in New York City, one of his apartments, there's a FedEx, $1,600. This was walking around money. The fact that it's cash money and it's not being accounted for, a convicted felon receiving cash in the mail, not accounting for it, not holding a bank account, that's going to raise a lot of eyebrows, and it certainly did raise our eyebrows when we saw that. Doug Cassidy, as I said before, wasn't a guy who was earning a salary. He's taking money under the table, and he's having people in the office send it to him, cashing NPS checks out of the operating account so that he can have money to walk around in Nantucket and in New York.
So that house of cards that Calvin kind of brought up that we will get to when we do the breakout, one kind of hint is that, well, what led up to this? He was a convicted felon before he started Lincoln Memorial. So I think that's kind of a really red flag. So again, just kind of keep that in mind. So in terms of, obviously, as I mentioned, that the guarantee associations were the biggest creditors. So we sued. It was the plaintiffs were the Texas Special Deputy Receiver, as well as all the guarantee associations. And it was on the basis of breach of fiduciary duty. So again, this is a very long timeline. 2014, I had been at the association for 2 years, and knee deep in all this legal wranglings, if you will. So again, it was just amazing to me that this, what did I get myself into, if you will. Again, I'm getting emails of these convicted felons. They've served jail. You can see the Cassidy family here behind bars. And then the people that really were able to send that $1,500 cash, right? Somebody had to tell them to do that behind bars. And again, these are for $435 million in restitution. And some are serving between 18 and 115 months. I had to do a calculation, 150 months, 10 years. So you're probably asking, well, where they are now. I think some of them have passed. Brett Cassidy, we'll talk about in a little bit. He's out now. So again, here's Brett Cassidy. Or no, this.
In researching and writing the book, I have a file of correspondence from people both within and without the funeral industry, and some former employees of NPS had leaked a copy of their sales manual to us that shows the scripts that employees are asked to use when they knock on grandma's front door. And it's all about getting in your living room or your kitchen, right? It's about making the person feel comfortable and warm. There are scripts in here that are suggested for use by the salespeople in order to get the customer to feel warm and like they're talking to somebody about planning a really important event for their family. And what it is it's good sales technique, but it is emotional manipulation. It's absolutely emotional manipulation. the salesperson is supposed to tell stories that the customer can relate to. Well, you know, I was talking to my mother the other day, and she told me about how she and her sister had really fought over the burial of a family member, and I thought to myself, wouldn't it be wonderful if I could give my mother a way out of this? And I thought you too, Mrs. Smith, might be interested in making this easier for your boys when you pass away. You know? I almost can't say it without using the unctuous tone that you know is supposed to be deployed. Everything has to be in sort of very calming and dignified and caring in tone, but it's about closing the sale.
So what I did attend the trial, and these are individuals that it was important that they not leave their family with a financial burden. And these weren't high dollar policies. And one of the witnesses was a lady who carried around her card saying, you know, that in the event of my demise, this is who you call, this is where you go to. So they took that money from my mom, my grandma, and they used it to their own gain. Or it was the insurance, the funeral home that they scammed to as well. So this really kind of, at least right now, even today, it gets my blood that they really preyed on people that really wanted to only do the best for their family. So this is Doug Cassidy here. He is the king of the Cassidy family. Everyone did whatever he told them to do, including his children. And you can see, I don't know how clear that is, but here is the American Express bill for $20,000 for one night in Shanghai. That my mom, my grandma, who paid that policy, paid for that. And so what was interesting here, too, is that you're probably wondering, well, what happened to him? Well, due to COVID, he was released and from the Federal Bureau of Prisons. But he has subsequently passed away. But the story does continue. This is his son, Brent Cassidy, and his family. When I attended the trial in Missouri back in, I think it was 2015, I think it was, that the last time I saw Brent, he was in shackles and his prison guard. I say that because you'll see him now. And then here is Brent Cassidy. So yes, there was an American Greed episode, and I'm sure some are probably YouTubing it now, on the Cassidy family. The 6 feet under was kind of based upon the Hollywood Forever, which was a funeral home or a cemetery that was, I think it's still there, out in California. You might know about that. That is still there. That was from all of this funding. So kind of going back now to the trial, it started in 2000. It was fascinating for me to see the jury selection, the jury pool, the instructions. And so I was there maybe for a week. And then I was there on the final day after closing arguments. The judge gave them jury instructions that were 27 points long. And so the jury was dismissed that Friday evening at 4 o'clock. We all went home, meaning my colleagues from the Guarantee Association, not only Illinois, but the other ones too, Texas, Missouri, Iowa. We were all very, very interested in this case. And so that was a Friday. The March 9th, 2015 was a Monday that they reconvened. They deliberated from 8:30 to 9:45. And the reason why I know that is I was getting, not texts, emails at that time from the law firms representing us. And kind of the key was the jury wanted to take a picture. That might be a good sign. So they came back and they awarded the Guarantee Association for $500 million in damages. They were represented by a very strong law firm too as well. Obviously, it was appealed, but to this day, it was something that I think that the Guarantee Association really worked together, worked collaboratively, and not one penny wasn't paid in death benefits. So I think when I talk about the safety net, that's the safety net that my mom or myself or my siblings would not have to pay. The Guarantee Association did. And it was because those that wrote in that life business, the solvent companies, they are the ones that stepped up and funded those claims. Again, Illinois was, I think, 68 million, and I'm not sure, I think it was maybe 500 million nationally. So again, we play a very important consumer protection role. Okay, so I talked about, last time I saw Brent Cassidy was 2015, prison garb, shackles, and I thought, well, I'm just going to Google him now, right? I was stunned, and I won't play all of it, but you might want to go back home or whatever, that there is a podcast that is My Big Mistake, I think it is. And I'm not going to play it because it's like 42 minutes, but it's fascinating. He has come back. He has his own business. Google Brent Cassidy. This is just happened to be this gentleman that was, I don't know, my biggest mistake. And Brent will talk about this. He released a book just, I think, around Christmas time. So again, he is still very much around. I think he talks through, how he got involved, how he did anything his dad did. And I mean, who wouldn't? So again, I just leave that for you if you are interested in hearing more about it. YouTube it and you will find a lot. So I say that to say this, that it can be sensational too, that this is really something that the massive fraud that occurred and that went unchecked for a long periods of time. But the Guarantee Association, because of the strength of the system and our member insurers, we were able to pay all of those claims, which I think is really, that's why we're here. I realize that, but I think it's really emphasizes the importance of what we do, why we do it, how we do it. Again, going back to my one-pager. Okay, let's recap. I think we've said this over and over again, that we are the safety net here. Again, subject to state insurance laws, and there are many ways: supervision, conservatorship, rehabilitation. Illinois has its own Office of Special Deputy Receiver, which is part of the Department of Insurance. Other states hire out their receiver. So again, we are a little bit different. And I hope that you've taken away that no two insolvencies are alike. I have Penn Treaty that, thought nothing could go wrong, everything was fine, but they aren't the only ones, right? A friend from Philadelphia, Pennsylvania really is really a unique state in terms of long-term care. We talk about fraud, what's going on there, untested model, new company. I think that I talked about the insolvency of the co-op in Illinois, very young company, right? They were formed in 2014 by the time when they went insolvent in 2016. And I don't know about you, but I think insurance is a very mature industry, and how you can compete with only being a couple of years old, that's pretty tough. And then the pandemic, COVID, I think that someone brought out how has the COVID impacted life and health. And at a recent board meeting that we did a presentation on that from our independent actuary, and really the life and health, they fared fairly well. And the reason why that was asked is from an insolvency perspective. Should the Guarantee Association, look at that? But what this really very extensive study showed is that we fared very well. I don't know if any of you have any other perspective on COVID and the impact, or if you have questions about that. I know that Ellie and I were talking last night at dinner that, when it first started, we thought, well, this is really going to kill the life, a lot of death policies or the health claims. Any questions from our audience in the internet? All right, very well. Thank you so much. It's been a pleasure and a privilege. See you next year. Thank you.
The Institute's Griffith Foundation, IRIF, and the Cady School of Insurance at Illinois State University thank Kelvin Schill, Senior Vice President of Financial Services at Country Financial, and Janice Potter, Executive Director of Illinois Life and Health Guarantee Association, for their well-crafted presentations. To learn more about Griffith Foundation programming, please visit www.griffithfoundation.org.